Hey everybody, welcome back to Investing Unscripted, where we ask and answer the hard questions about investing. I'm Jason Hall. That is Jeff Santorini. He is the voice of the people. Hey Jeff.
No, that's not what I was called. You got to get the fake name right. It was Santoso, which is terrible.
Yeah, it was pretty terrible.
I want our listeners to know that you screwed up the beginning of the podcast again, because it happens
I always
It happens like every. I don't get it. We've done hundreds of these.
I think that I've actually built up the muscle memory or the synapses in my brain that fire. They're the wrong ones.
Yeah,
Have
I'm
you
not
ever
sure anything's firing inside your brain, to be honest.
Touche. We had somebody on our YouTube that posted that half my head was gone, and our social media intern replied, "We're not sure if it was the half of the head with the brain in it or not." So,
well, that assumes there ever was a half a brain.
Touche once again. All right, we have a guest waiting in the green room.
I know we're being rude here.
We are. We should bring our guest onto the stage. It's Todd Wenning. Todd Wenning does a couple of things. Todd Wenning helps people manage their money. Also is the person and the brain behind Flyover Stocks, the newsletter. It's a good chance if you're listening to this and you're active on social media, you've probably seen Todd on Twitter. And we were lucky enough to spend some time at Berkshire in Omaha with Todd. Todd, thanks for coming on, man. It's really great to have you on here with us.
Hey, thanks for having me. It was great to see you in Berkshire and get to know you. And it's been great to get to know you the past couple of weeks and great to be on.
Yeah, we're glad to have you on. That's for sure.
Yeah, this was a good test case for us, like someone who actually meets us in person and then agrees to come on the podcast. So,
sure. It's often the other way around. Yeah, there's no doubt
it's usually
about
like
that.
they meet us for the first time on the podcast and they can't get out of it. So you're a true American hero, Todd.
Good to hear.
Especially considering, Todd, that I spent a good 2 minutes of literally the first part of our conversation insulting New Jersey because Jeff was there.
Yeah.
Which I have to insult New Jersey when Jeff is around. But of course, you have ties to New Jersey. And I didn't know this, but I spent a good 2 minutes just trashing Jersey.
That's okay. I do it in the privacy of my own home as well. I went to middle school and high school in New Jersey.
It's all right. People from New Jersey can handle people making fun of New Jersey. It's fine. It's all good.
All right, Jeff, go ahead.
All right, so let's dive in. Enough silliness here. Thanks again, Todd, for coming on. The first thing we typically do whenever we have a guest on is just give them an opportunity to tell their origin story, how they got interested in the world of investing and their career trajectory. So take that in any direction you'd like to, but how did you get here?
Yeah, there's a long version and a short version. I will try to keep it as compact as possible, and I will let you guys pull any threads you think are interesting. But I have this sort of a non-conventional background, and I was a history major in college, and the plan was to be a teacher or be a lawyer. I eventually got to the teaching part, but I never got around to the law part. And hindsight tells me that was probably a pretty good decision for me, partly because I discovered the investing world, which tied in a lot of the things I loved about the law to begin with, but also helped me find a way to make money and help other people make money. And so when I started my first job out of school, I went to St. Joseph's in Philadelphia, and my first job was with Vanguard. And I still, to this day, do not know how or why they hired me. I had no financial experience whatsoever, but I did have a good undergraduate track record. And I most importantly, I worked on the phones in the admissions office. And so they must have thought, well, this guy can talk on the phone. He can pass a test. We'll get him on the phone. He teach him how to help people with their money. And so that's what they did. And so for the next 2 years, I got my Series 6, 63, and Series 7 license eventually with Vanguard, and then made my way down to the DC area where I started out working for a bank and then eventually worked for what we share together, the Motley Fool. I lived in Alexandria, Virginia, worked for the Motley Fool for a collective 6 years, and then went to Morningstar, where I was on the sell side for 3.5 years, headed up their equity stewardship methodology, and then came to Cincinnati, where I currently live, and where I've worked on the buy side for first Johnson Investment Counsel, then Ensemble Capital Management, which is based in San Francisco. I worked from Cincinnati the whole time, and I launched my own firm in September of 2024 called KNA Capital Management.
Folks, we'll have a link to KNA Capital Management in the podcast description, the show notes. So if you're curious about that part of what Todd works, there'll be a link right there. You can go check that out. I'd like to start, Todd, with the Motley Fool. Again, there's some shared background there as a content publisher, and making your professional trajectory moved more into actually directly engaging with people and helping them make decisions and actually making decisions on their behalf with their assets. I'd like to talk about Flyover Stocks first, and then we'll work back around to your career trajectory. Thinking about Flyover Stocks, what were the decisions around starting a newsletter? What purpose initially did you want it to serve for you professionally and personally? What role does it serve for you today?
So I've been writing publicly about investing, starting with The Motley Fool since 2006. So almost 20 years now. And so naturally it's become part of my process. Just anyway, I like to write and I like to write about what I'm thinking about. If there's something I'm not 90, 100% sure of, I want to write about it. I want to think about what I think. It's a great privilege to do that because and a great responsibility, especially when you write publicly. I always encourage people to write anyway. But when you're writing for a large audience, my first writing was with The Motley Fool and it had a huge distribution. So already people were reading my stuff and looking back on some of those things, I'm like, man, I wish I had been a little smarter when I started writing, but that's all part of the process. And that's really accelerated my learning process. I learn faster by writing. And it's part of that. By doing it publicly, you start thinking, okay, I'm going to say this. And what might someone say who wants to counter that point? And how can I address that counterpoint before I even finish the article so that we can have this conversation and I can think about all the different bases that need to be covered. And I think that helps you accelerate your learning because it does make you think about the opposite point. What could someone say that would counterbalance this point?
Yeah, I had a similar realization when I started writing for The Motley Fool, very part-time because I have a full 9-to-5 day job. But I remember thinking to myself, stepping into deciding to write something, I had a particular level of conviction about a stock that I was going to write about. And then by the time I finished writing, I either had much less or much more conviction. And that taught me that, similar to what you said, Todd, like the act of writing it, the act of thinking about it being public facing and kind of having to defend my points, like journalistically for one, but also if someone pushed back on me, could I defend myself? It was so clarifying. I think anyone who's a serious stock investor, I think should try to find a way to put their thoughts out publicly because it can sometimes completely change the way you think about a stock, or at least that's what it did for me at times, especially when I was very beginning at it.
Yes, that's right. And it's become part of my process. And when I started Flyover Stocks, that was front and center. I've always, even when I was at Johnson Investment Counsel or I was at Ensemble Capital, where we did a lot of writing, once I stepped away from the Ensemble Capital, I still wanted to write. I still wanted a platform. And when I was at Morningstar, I had a column called Seeking Small Cap. And so I was looking for small cap stocks that were officially covered by Morningstar, but exhibited moat-like characteristics. And that got a decent following. And I would still get emails from people saying, oh, I remember that column. And so when I launched Flyover Stocks, I thought, let's do something similar to that. Not quite as constrained to just small cap stocks, but stocks that people may not know a lot about, but are still really interesting businesses that probably have some sort of durable competitive advantage. And so that serves me in a number of ways. It helps oil the gears, so to say, for research. If I was just managing my 19 stock portfolio, I may not get new ideas all the time, but this requires me to do that once a month. And I often find I have links. So that reminds me of this, or that reminds me of that. And so it helps kicking pattern recognition. And I've eventually, through the KNA Core, I've ended up buying some of the stocks that I've written about when I thought the price was attractive. So it serves as a way for me to build a bench of ideas as well.
I was listening yesterday. Tom Gardner was talking to Howard Marks of Oaktree Capital. I feel like this is basically the same conversation we're having now, same level of people too.
I'll be Howard Marks.
No, I'm pretty sure Todd's Howard Marks. That exact idea that it's so easy just to kind of fall in love with your ideas, especially if they're working, and forget about disruption, forget about other opportunities. And the next thing you know, a few things that were going great all of a sudden are not going good anymore. And you don't know what to do, right? You don't know where to go. And you've missed out on other opportunities because you weren't continually sharpening your tools, greasing the gears, however you want to think about it. So, I appreciate that as a smart way to kind of leverage that. You talked about moats, durable moats. This is something coming from meeting for the first time in Omaha, the land of investors looking for durable, true economic moats and competitive advantages with Flyover Stocks, I know that finding businesses that have those characteristics is part of it, but that's only part of it. What else are you looking for with Flyover Stocks? I think part of it's in the name.
So one of the things I really like finding are companies that are not well followed. And those companies are usually located well outside of major populations. So finding companies that are located in Iowa or Kansas or somewhere in Ohio, that where I'm currently located, that may not be on the regular beaten path for investor presentations and road shows. And it takes effort to get out to meet with the companies. And sometimes the culture of these companies is different from what perhaps the investor class in New York or San Francisco or Chicago are looking for, trying to find. They have a real focus on longevity, on taking care of their employees. A lot of times these companies have very low turnover. These are lifelong employees. They are the major employer in that region, and people that set up their entire careers there. So they're often managed differently than companies in, say, San Francisco or in New York City.
Would you say that that management piece is, to whatever degree there's like a criteria that leads you to actually write about a company? Is that a big, it sounds like you're pointing to management a lot, like the way that they run the business. Is that, would you say that's a core component or core value of what makes a quote unquote flyover stock that you write about? Or is it more about that's the pond you fish in, if that makes sense?
Management has increasingly become important to me, partly because we're living in such a dynamic period in the economy and geopolitics and everything, technology. You need to find someone who, or a team of people who are able to adapt and put on a stewardship mindset. So thinking about, okay, do we need to sacrifice something about the company now so that in 10, 15, 20 years, this company is still relevant? And that is a skill set that is hard to find because most CEOs of public companies are professional managers. They are there for, on average, 4 or 5 years in their role.
Yeah, I read that a couple of years ago, that the average tenure of an S&P 500 company is less than 5 years.
Right.
Stunning. It's stunning. Now, a lot of those, of course, were internally promoted, so they have history with the company, but still, how can you act long-term when you're spending less than half a decade at a company?
That's right. And what I think you need to look for are qualitative factors. So are these people intrinsically motivated by the job, or are they in the role to maximize their equity grants, stock options, and move on to the next job? And that's something that requires a little bit of extra work. Because if you're just looking at the management list, looking at their experience, you might say, oh, they came in from private equity and here they are, and they've got all these ideas, but are they really going to be here? Is there something about this industry, this region they're living in, that matters to them beyond just the paycheck? And that's qualitative. That's not mathematical. And that can be something you can't find on AI or on algorithms or any sort of screen.
You can probably see something a little bit about it on the proxy statement, though.
The proxy statement is the first place I generally look when I look at a company. Is I want to see who owns the stock. Does management own the stock in size? How long has management been there? Who's on the board? That tends to point me in the right direction, because by the time I've gotten to that point, I've probably looked at the screen. I've probably looked at some ratios, or I've heard about this company from another investor that I respect. So they've done that filter already. And so first thing I go to typically is the proxy statement to try to understand things like, are there related party transactions, or is anybody married to anybody else? Things like that. Just try to understand who are the people behind the business. Then
Does the founder and CEO own a jet and 35 of the pieces of real estate that the company is operating out of that they're paying to lease from the owner of the CEO?
Right. So those things are actually, I find, quite tricky. I think I've changed my mind on that a little bit.
Yeah.
I think especially for founders, I think if you have founded a company and you've grown it into a multi-billion-dollar business, you've earned the right in some ways to enjoy the fruits of your labor, because you've sacrificed years and years of your life and your, maybe time with family and friends, and now you're trying to make up with it. And I think that can be, I give a little bit of leeway, more than I used to, right? In the past, if I saw that the company owned a corporate jet, I would immediately write it off. But now, if I understand a little bit more of the nuance, I might be open to that. So now if this person is just a new hired CEO from outside the company and is flying all over the world on the corporate jet, taking the family, going on vacations, that's a different story. But when it comes to a founder, I tend to be a little more lenient.
So you mentioned when I asked when you started the answer to that question that we live in these uncertain times and so much is going on, which is a perfect segue to something I wanted to ask about, which is as someone who has been writing about stocks and companies for many, many years now, and also, is now advising people with their money, I have to ask how you're thinking about the current environment we're in, right? There's all this news about tariffs, whether they're on, whether they're off. Either way, the uncertainty that causes looking into the future, it's got to be impossible for management teams to make any decisions they can feel confident in, not knowing what's going to happen, forget 6 months from now, but just tomorrow or later this afternoon. So I'm just curious, as you think about new companies to look into or write about, or even as you revisit ones you've already covered, how are you thinking about the crazy times we're living in with policy changes, tariffs, inflation, interest rates, all that?
I think that goes back to wanting to understand management at a deep level, trying to sense of how do I think they're going to respond to changes. I don't want to go into a crisis mode with a leadership team of any company that I own where I'm concerned. I have this in the back of my mind. Are they gonna cut and run? Are they gonna do something desperate? And a lot of that comes back to the company culture, it comes back to management, their intrinsic motivation, how they responded in the past to different challenges, but also how are they set up financially? And going beyond the proxy statement, looking at the balance, are they heavily indebted? Have they just taken on a huge acquisition that they're trying to fight through? Because if, using the Game of Thrones term, winter comes, right, they will have limited options if they are contractually obligated to pay large amounts of interest and principal payments. So looking at balance sheet health, if a company has no debt and they've got a strong competitive advantage and economic moat and wise stewards running the company, I'm about as confident as I can be going through the storm with that company. I don't want to lose sleep over any company that I own. It's always possible somebody does something I don't expect, but if I'm doing my job correctly, and I'm trying to understand the character of the leadership team at the companies that I own, I'm willing to take that bet. I mean, at some point you have to say, I have faith in this management team. I don't know what's going to happen. I don't 100% know, but I'm confident that they can get through this. And looking for companies that have that anti-fragility, not just endure these struggles, but use them to get stronger. And I had one of the companies that I own in the portfolio was talking to me during tariffs, and they were saying, look, we have 90% of our customers are supplied locally. So wherever they are in the globe, 90% of their supplies come from, a 100-mile radius or something like that around that customer. And that was done because they were taking a focus on sustainability. They were trying to cut down transportation costs, trying to fuel and energy. And so they had this positive side benefit of not having to worry as much about tariffs because they had already been thinking longer term about how can we make this business sustainable? How can we make it anti-fragile? How can we reduce risk? And so while their competitors are probably struggling, they're capitalizing on those opportunities. So those are exactly the type of companies that I'd like to own.
Hey, everybody, we'll be right back. But first, a word from our sponsors. FinChat.io is the complete stock research platform for fundamental investors. They have all the standard financial data on more than 100,000 stocks globally. But beyond that, they have company-specific segment and KPI data on around 1,800 stocks. So for example, do you want to see NVIDIA's data center revenue growth? They've got it. Do you like to track Apple's iPhone sales? They've got that too. Or how about nights and experiences booked for Airbnb? You guessed it, they've got it. And they just added around 8,000 ETFs and mutual funds to the platform. The breadth of FinChat's data is truly one of a kind. I use FinChat every single day as I'm researching the stocks in my portfolio, specifically when I want to see how they're doing on KPIs that FinChat is famous for. So to get 15% off any paid plan, go to finchat.io/unscripted. That's finchat.io/unscripted to get 15% off any paid plan today. The link will be in the show notes.
Hey listeners, my name is Brett Schaefer, one of the hosts of the Chit Chat Stocks podcast. On our show, we do comprehensive stock research reports, interview analysts, and learn from great investors. And we have coverage on stocks like Airbnb, Nubank, Mercado Libre, and many others. Plus, we cover all the hot financial news on our weekly investing power hours. We have episodes for all types of investors, and think if you listen to this podcast, you will enjoy ours as well. Follow the Chit Chat Stocks podcast on YouTube, Spotify, or Apple Podcasts, and start discovering new investments today.
So there's a couple of parts of that I want to unpack that I think are important. One of the things that we've heard from some of the best investors in the world, Peter Lynch has talked about it, Buffett and Munger both talked about it, others, is the quality of the business is so important that whether it's an idiot or a ham sandwich, however you want to describe it, that the business should be able to survive poor management or subpar management. And I bring that up for a couple reasons, because we've spent a lot of time talking about the importance of excellent management and the characteristics that we look for. Management's not a moat, right? Because that can change quickly. You talked about the strength of a balance sheet, which is massively important, but it's also not a moat necessarily, right? Because it's not guaranteed to be durable. It can be a massive advantage, but again, it's not a moat in the truest definition of it. So thinking about those things, and those are almost like second level questions maybe that you're asking. I don't want to put words in your mouth, but from what you've described so far is those things are important, and all other things created equally, you have two great businesses and one has measurably superior management and a better balance sheet, cash flow profile, whatever it is. Everything else created equally, obviously you have a business that is superior. But what are the key characteristics of the companies themselves in terms of things that you're looking for that you would describe as aspects of the business itself that make it superior? Are those durable competitive advantages that you're looking for?
So there's 5 general buckets that I look for in an economic moat. And these are straight from the Morningstar approach. So my training. So things like network effects, switching costs, low cost production, intangible assets, and efficient scale. The 5th one is debatable, but I'll throw it in there. And we can go through these one by one, but think about network effects, think about Facebook, eBay. The more people that join, the stronger the whole network becomes. The switching costs. There's a lot of great switching cost businesses. So this is where it would cost more for a customer to change out of their current provider than it would be just to retain them and take on higher prices every year. So in the financial industry, Bloomberg is the exact type of company that would have some sort of switching cost. So if you go into any trading floor in the US, they've got a Bloomberg. They could double the price, triple the price. It probably wouldn't change the fact that every trading floor has a Bloomberg. That would be switching costs. There's plenty of other examples like payroll software, things like that. Intangible assets, that's sort of a catch-all, but brands, patents, regulatory benefits. I'll throw culture in there. We can pull that thread if you want. Low cost production. So these are companies that have assets like, if they have a rock quarry near a lot of construction, you're not going to be able to compete with them if you're shipping in rock from 300 miles away. So they have the transportation advantage. They have an inherent cost advantage. And then efficient scale, the best one to describe that is like an airport. So there's a regional airport can generate certain returns on invested capital, but if another airport came in, it would reduce the returns on invested capital for both parties to below the point where it made sense for them to continue to invest. So there's only so much room, in other words, for a certain amount of companies, and anyone who's currently there can benefit from the economics, but anybody new would not.
That ties into barriers of competitive entry.
Mm-hmm.
There's 2 of those things you talked about that I think are really compelling. I want to talk about the cost structure and the intangibles together, and then we can talk about culture as well. So when I think about intangibles like brands, usually when your brand is an economic moat, you have pricing power that comes along with it. To me, maybe the most prime example that we have like living proof of is Coca-Cola, because even though consumer tastes have changed, and in the West, we've seen soda volumes be very, very challenged, their ability to continue to raise the price of that product has resulted in continually growing their cash flow and profits over the long term. Even as they've had to adapt to that changing marketplace, that brand power has allowed them to continually raise their prices. Are there other aspects of brand as an intangible that beyond the pricing power aspect of brands, what other things do you think brands bring?
I think brands have to have an emotional connection with the consumer. And Buffett has talked about how Coca-Cola's strategy is to be everywhere you're happy, right? So at a sporting event, at a movie theater, at a park, right? They want to be able to They want you to subconsciously link Coca-Cola with happy memories. And I've often told the story where whenever I drink Coke out of a glass bottle, it reminds me of doing that at my grandmother's house 30, 40 years ago.
Mm-hmm.
And so they have this subconscious connection, whether it's, and sporting teams have the same thing, right? So sporting teams, baseball, basketball, football, soccer, they get passed down generation after generation. You have happy memories talking about Cincinnati Reds, Cincinnati Bengals. Well, not always happy things with the Reds and the Bengals, but we have these conversations and these connections.
Hope reigns eternal, pal.
Right.
Hope reigns
Right.
eternal.
With parents, with children, with grandchildren. It's a way to connect the ages. And so having those brands emotion makes them really difficult to unseat. There's nothing special about the Coca-Cola ingredients. I mean, someone could just get close to it. I mean, they had the Pepsi challenge and all sorts of things, lots of challenges to the Coca-Cola brand over the years, but people aren't going out and collecting some of these other icons, right? They're going to the gas station, the old gas station signs, they're the old Coca-Cola freezers. There's a certain value, certain connection, a certain nostalgia, which is a key theme in my portfolio that I thought we could talk about too. But I think that's really hard to unseat. Once a brand has
emotional switching costs,
right? Emotional switching
costs. Yeah.
Good way to put it.
So let's talk about the cost advantages again. I think this is something that maybe is underappreciated, particularly in industries using a quarry, for example. We could look at oil and gas, pretty much anything in the energy world, and a lot of other industries too. You're a price taker, right? You have no pricing power whatsoever. So where you make your money is on the margins of doing things to position yourself where somebody else can't come in and undercut you in some way, and you can own a market. Right.
Right. It's not just low cost advantage is often talked about with basic materials, chemicals, oil and gas, like you just mentioned, but that can also apply to the financial world too.
Yeah.
Think about a company that I've owned personally for almost 15 years now is Admiral Group in the UK. And it's an insurance company, and they're just completely infatuated with lowering costs. And there's a story where they launched the US version of Admiral called Elephant, which they recently sold, but it's a low-cost insurance, car insurance mostly, but they've branched into others. But when they launched in the US, one of the things they talked about in a local newspaper that I read about was anyone who wanted to do a copy at the copier, they'd have to go do a push-up in front of the CEO's office for every page. So if they wanted to print 20 pages, they had to go do 20 push-ups. And so it's this idea, this culture that we're going to keep costs to the bare minimum. And so their expense ratios relative to their peers is extremely low. So the advantage there is that when rates go down, their competitors are really struggling, but they still have plenty of breathing room to turn a profit despite the fact that rates are down. And so they can continue to pick up share because they can keep marketing while their peers are cutting back, trying to break even. So it's this idea of cost obsession. And there's really one of two ways that companies can generate high returns on invested capital. One is by having a real cost advantage. And the second is having differentiation. What's really different about your business from the rest of the group. But the companies that have low profit margin, but high turnover can generate high returns on invested capital just as well as companies with high profit margins and low asset turnover.
Yeah, there's some companies in the automotive repair retailing space that have showed, like O'Reilly, for example, has shown that you can be so much better than the company that looks like they should be the same thing as you, just by being smarter about turning inventory more quickly and turning inventory into money before you even have to pay for that inventory.
Right.
There's some remarkable stories out there about companies doing that. I just want to mention too, like KNA Capital is an insurer that has done a lot of the same thing by staying specialized, building a business from the ground up, which has allowed them to avoid a lot of layers of cost that a lot of the larger property and casualty insurers have built up and become siloed over the years after multiple acquisitions and old technology and that kind of thing. So that's one of the things that, to me, that's most compelling about finding companies in the financial services space, newer businesses that aren't trying to repackage things and call it fintech. The ones that are just saying, we can do blocking and tackling better by building the business from the ground up the way that it should be built today.
Yep. Yeah. I mean, I think anytime you can unburden yourself from these high cost inertia from a lot of other firms, it can be a real advantage. I know in the insurance space specifically, if you have a new platform and you can scale it, that can be a real differentiator because a lot of the existing legacy insurance companies through acquisition have different layers of IT and different parts of the business that don't talk to each other. And that can be a huge opportunity for someone who understands the technology, is building it organically, and isn't doing it through acquisitions.
Let's pivot a little bit and talk about both Flyover Stocks and also the advisory business. Because one of the things I'm curious about is how you think about who's the right person to take advantage of either one of those things, right? Like, so who's the ideal person to subscribe to the newsletter and get value out of that? And who's the right person to maybe consider advisory services? Where do they overlap? And like, how do the two endeavors you have here benefit each other, I guess is the way I would say it.
Yeah, so the benefit is really just the Flyover Stocks gives me an outlet to do the research and keep, with KNA Capital, I write monthly, but sometimes things come up intramonthly and I want to talk about it, or I want to fish something out, flesh something out. And that's where Flyover Stocks come in. In terms of the ideal client or the ideal customer for both, for Flyover Stocks, it's really somebody who wants a monthly deep dive into companies that they probably haven't heard of or that aren't written up regularly on Wall Street or by sell-side analysts or find themselves in the press, companies that I find interesting. So whether or not you say, yeah, I want to look at this company deeper, I don't give buy-sell recommendations. I say, here's what I think the stock is currently pricing in based on a DCF. I do reverse DCFs usually to figure out what could be implied in the current stock price. And you can agree or disagree with what the market's assuming. But it's really just, here's a company that I think you should know about, that I've done what I consider to be the level that I would bring to a portfolio manager and say, hey, this company's interesting. We need to put it on our watch list. We need to pay attention. And so my clients, my subscribers, they're very happy, I think, hopefully, with the content that I'm putting out there. And so it serves them. And so they're getting a new idea every month. They might find one idea a year where they're just, this is exactly what I want to own, and the subscription pays for itself if it does well, hopefully. But I leave it up to them in terms of buy-sell decisions. Now, KNA Capital Management is a bit different. That's my registered investment advisory firm that I have here in the state of Ohio. And my ideal client there is someone who understands business. So they are either a business owner themselves or we're a business owner and want to have their investment portfolio managed in a way that is business focused rather than security focused, right? I'm not going to buy index funds and charge you 1%, 1.25%. I'm going to really focus on owning what I consider to be great businesses that I myself own. So my family and I, most of our investable net worth is in the strategy. And so we're invested right alongside you. And so anyone who reviews what I'm doing, likes what I'm seeing, likes what I'm investing in, we have a conversation. If it fits for them, great. And I've got some great clients who understand, and if the market goes up, great. Market goes down, great. But end of the day, we can take some confidence that we believe that we own some great businesses.
I have a follow-up because one of the things I've been thinking about a lot over the last couple months, and Jason and I have talked about this, and I just pull back to like the current events, macroeconomic news and news cycle that we're in. I'm curious how you think about balancing what you think or what you feel very confident is a rock solid long-term investment, right? A stock that you have high conviction will be a winner, let's say 5+ years from now, against what might be a rough years 1 through 4, and making that decision. Because I struggle with this for my own investing portfolio. I got to go back and forth. Part of me is like, if stock A is going to be crushed by tariffs in the next 2 years, but I believe in 10 years it's going to be fine, now's the time to buy stock A while it's beaten down. And then the other side of me is like, yeah, but if I just wait and buy stock A 3 or 4 years from now, I can dodge all of this uncertainty and near-term headwinds. I'm just curious how you think of that, like balancing what you think is a good long-term opportunity versus what might be a high level of conviction in some short-term challenges.
I think part of it is doing the valuation work, trying to figure out, okay, what do I think cash flows are going to be in 5, 7, 10 years from now? And what am I willing to pay for today? If the economy is, or if the market is giving me an opportunity to buy at a discount to what I think the stock is worth, I should buy it today because A, I don't know what's going to come down the pike in terms of the economy. And I might not get another chance. I can go on and on about the number of stocks that I said, I'm going to wait 6 months, a year, 18 months, and I'll buy it. And stock just ran by because the market is a forward-looking instrument, right? The market is not thinking about what's happening next month. It's thinking about the long term. And it's maybe not explicitly, but implicitly, because if you believe that the stock price represents future cash flows discounted back to the present, what that's implying is that the majority of a company's value is in its out years, in its terminal value. So what this company is going to be worth or generating in 10, 15, 20, 30 years, not next year. If you do a discounted cash flow evaluation and you figure out how much of my ending value comes from my terminal multiple or my terminal value, you'll see that it's at least about 65%. For high growth companies, it's usually like 90%. So the market is thinking not just 6 months from now, it's thinking longer term. And that's why you see, like we had in 2022, a lot of these companies that were really benefiting from zero interest rates, right? Once rates started coming up, those distant cash flows became worth less because the opportunity cost for waiting got higher. And so it's extremely important to think the time value of money and trying to figure out, okay, what am I willing to pay? What am I giving up? I'm setting out cash now that I can't earn money on at the same time, right? I'm giving up something for something else in the future. So what am I willing to give up now? Am I willing to put up with a little pain over the next 1 to 3 years potentially? Yes. I mean, if you think about it take the market out of it, right? If you had an opportunity to invest in a great local independent business and the economy, you got it for what you thought was a pretty good price and you're wanting to own it for 5, 10 years, what's the difference? Whether you buy it now or in 2 years. If you can time it, that's great. If you can figure that out, give me a call. Best with you too. But it's really difficult to do that. And so I think it's important to, when you have the opportunity, based on what you know, what you are confident in projecting, if you get a discount, I think you have to buy it. I don't think you can wait and hope for a 20% pullback. It's really hard to do.
Yeah, I think I lean towards the DCA into it if you're unsure of the short term kind of vibe, because I agree with you that there's nothing worse than saying I'll buy that later and then watching it 5x over that time. That's a terrible feeling.
Half measures tend to be a good approach. I've had work with people who have large concentrated positions, for example, and they're not quite sure what to do with them. They want to avoid the regret of selling, but they also want to avoid the regret of not selling, and the stock goes down, right? So half measures tends to be the right way to do that, because from a behavior, so maybe sell a little. That way, if it goes down, you feel like, hey, I took a little off. You're not going to beat yourself up so bad. But if it goes up, you still participate.
So I'm curious, kind of sticking with your investment advisory business. I've learned as an investor, so much of what I do around my process and the framework that I've built is designed to help me optimize for me, how I think, how I act, my weaknesses and strengths, my cash flows, where I am in like that continuum of life, and trying to optimize for that. So how much of your time do you spend managing your clients versus actually working on the portfolios?
Well, it starts with great clients, and going through that initial sign up process is so critical to make sure that you are on the same page, that if the market drops 20, 30%, I'm not going to be getting phone calls wondering what's going on. And my clients, to their credit, I didn't get a single call during April when everything was going crazy.
Did you change your phone number?
Yeah. But I think the important part of that, and I went back and I've read Chuck Ockrey, his investor letters from the 1990s. And one of the things that I picked up from him was it's important to communicate ahead of time when things are going well. Things are going well. Hey, this isn't always going to be the case. Sort of planting that seed that, hey, we might have a pullback. And so when the pullback happens, it's not like everyone was expecting the market, your portfolio to keep going up 15, 20%. That goes with the monthly communication, right? Letting clients know how I'm thinking so they're not wondering. That's the worst thing an advisor can do, in my opinion, is go silent, because you're managing someone's life savings. You're managing their inheritance, what they're going to give their children one day, their nephews, nieces, whatever it might be. That's their labor. That's the products of their labor. Like, it's important. And so fortunately for me, I've always been able to communicate. And that's always, every firm I've worked for has been very proactive on communication. So it's become sort of second nature. But I think that is one thing that advisors could really do to improve, is communicate ahead of time and make sure that the clients know that the good times won't always last forever, and the bad times won't last forever.
Yeah, because otherwise you just sound like the guy going, relax, it's fine.
Right.
And that, I know from being married, that never goes over well.
That's right. Calm down is never a good response. Yeah.
So I have one quick follow-up, and then we can dive into our lightning round questions here. So we have, I would guess most of our listeners are not the reverse DCF kind of people. And I know you referenced that a few times, and that you use that for evaluation work. And then I actually think it's something I'd love to incorporate more into my own process at some point in my life. But how do you advise regular retail investors who want to do the work, right? They're interested in reading 10Ks and 10Qs and listening to earnings transcripts and learning about companies and reading proxy statements and all that stuff. But the heavy math aspect of doing a reverse DCF or really diving into that is sort of beyond their interest level or maybe even their ability level. Do you feel like that's a super important aspect of being a successful retail investor? Or do you think there are ways to maybe get to the same conclusion without having to actually go through the work of the DCF? I'm just curious how you think about that.
One of the big turning points for me, and I think it was Michael Mauboussin in one of his papers, was talking about how whether you're going the multiples route, whether you're using PEs or you're using the discounted cash flow models, you're doing the same work. It's just that the price to earnings multiple or the EV to EBITDA multiple, you're making implicit assumptions about what's going to happen in the future. With the DCF or reverse DCF, you're making explicit forecasts. You're saying, I think the timings of the cash flows are going to be thus. And so you can keep track of that. And I think ideally you work towards that DCF because it's just opened up so many new ways for me to start thinking about the business. If I was just going off the multiples, I don't think I would have a deeper understanding of why that connects with the multiples, what's going on in the financial statements. So that said, that comes with experience. That is not something I could have done my first year investing or my fifth year investing. That took time. I did the CFA. I worked through with a bunch of models from people with Motley Fool, trying to understand what was going on. And it takes time and effort to do, but I would encourage people to get in that direction. That said, I think that if you're like, well, I'm working towards that, but for now, what am I supposed to do? I think a good sense is try to get a feel for what the overall sentiment is about a company. So if you're researching Coca-Cola, let's say, and everyone on TV is just raving about Coca-Cola and everybody's talking about Coca-Cola, that's probably not the best time to put 20% of your portfolio into Coca-Cola.
Yeah.
So maybe you put 1% of your portfolio if you're really interested. You should try to figure out, okay, it's when you have these sharp pullbacks in sentiment that your understanding of the business can serve you well. There's plenty of times over the years, Amazon had 90% drawdowns, but if you still believed in Amazon as a consumer, and I know like David Gardner did from the Motley Fool, he understood, hey, I see this vision. I understand where he's taking this. And maybe not AWS, but I see the retail opportunity. I'm going to continue to invest and stay with this. You can really get an advantage because institutional investors and professional investors do have clients that are thinking about the 6 month, 9 month performance. But if you as a retail investor can have a conviction in the business that you understand, I think that's important too. So if you're a retail investor, don't go buying oil and gas stocks in general, unless you work in the field or you have some understanding of where you are in the cycle. That's something too to understand. So alongside that, thinking about sentiment, thinking about where you are in the cycle for that business. If you're looking at trucking, has trucking been on a roll for 6 months to 2 years? If so, it's probably in an upcycle and you probably missed the big swing. But once people start doubting trucking, maybe you start tiptoeing your way in. So trying to get a feel for sentiment wise and sort of like where you are in the cycle about each company.
Todd, I caught that trucking pun, by the way. Trucking.
Yeah, that was good. I didn't want to interrupt you, but that was well done.
Slid it right in there.
Yeah, we've talked about it before, like the idea of running towards fires, right? That's the time to be. I think the most recent high profile one that I can remember the last couple of years was probably like Meta, when right before the year of efficiency. That seemed like that was the time when a lot of what I heard in the zeitgeist of investing was like, oh yeah, they're burning too much cash, Reality Labs, maybe they've lost their edge. And then I think the stock's up like, I don't know, a couple 100% since that point.
Right.
All right, Jason, let's get to the lightning round here. Why don't you ask the first question?
All right, so we're going to come at you hard here. What's the worst flyover stock investment that you were sure would go great but didn't?
I don't know that I would say I was sure it would go great, but the most disappointing one from an operational standpoint has been grocery outlet.
Okay, why?
So grocery outlet, they're sort of like the TJ Maxx or Ollie's of the grocery space. So it's in their name, grocery outlet.
Right.
And
hard discount grocery.
Hard discount. So you can go and get brands for 30, 60% below what you would at the grocery store. So they sell like overproduced, over inventory brands. It's just they've had overambitious growth targets. They've had a lot of turnover in management that I didn't expect. And so they have a CEO change. And so right now they're kind of in the penalty box. And I probably wouldn't have recommended them today. It's not a recommendation necessarily, but I wouldn't have profiled them in the Flyover Stocks if I had a better sense of their corporate turnover.
All right, now let's invert it. What's the one where maybe you had more modest expectations, but the results exceeded what you were expecting?
Yeah, that would be Hawkins. Hawkins has been just on a tear since, and now, no, I'm not saying I called that, right? I'm just saying that I profiled it and the stock did really well after that. They have one analyst covering them. The major business is chemical distribution, but their growth business is water treatment. And that has been on an absolute tear. And so the stock has, I think, close to up like 80 to 90% since the profile. It's done really well. And just, I wish I had started my portfolio, but when we talked about it at Flyover Stocks, because I picked some up. But yeah, it's been on a really good tear.
So two things. First, you absolutely should take credit, Todd. Take credit for that. Do it. And the other things I'm curious, do they have any overlap with Badger Meter?
So they, to my knowledge, no direct competition with Badger Meter. Badger Meter might be involved in some of the projects that they're working on in terms of measuring the water flowing through the system. But they do a lot of chemical treatment, so like municipal water. If you run a farm, for example, and you're using well water, how do you get the water to be the balance that you want, the cleanliness that you want for your livestock, for your farm, for your agriculture? So they do a lot of consulting on that.
All right. So we ask this of everyone who comes on. What's the most important thing that retail investors should be doing differently to help improve their results?
When in doubt, be more patient. I think when you're a retail investor and you don't have the knowledge yet, and this is true for professional investors too, not just retail investors, but err on the side of patience. During April, for example, during the tariff sell-off, I teach at University of Dayton. And for 3 days a week, I wasn't looking at my stock tickers, and just inaction just kept me from making probably a lot of mistakes. And so I think you read the headlines, you get caught up in them. And the thing is, by the time it's in the headlines, it's already been processed. And if you're a retail investor, you just you're not going to beat the market on
speed to market is not our advantage.
No, patience is our advantage as retail investors. And so to the extent that you can generate that in your own investing, I think that's the key.
Yeah. And I think it isn't just panic selling either, because we think about during times like April, where a lot of people were exiting the market. And here we are, we're within about a percentage point of the all-time highs again, with all of the uncertainty that still remains. But panic buying is a thing too. So that patience, it works on both sides of the transaction.
That's right.
Yeah. A recent example for me, like when the trade desk dropped like 30% after earnings, if you bought like a day or two after that, I think it dropped another 10 or 15%.
Yeah, no, you were still down about another third. Yeah.
Yeah. So a little patience there would have helped. All right. Last question. Let's flip it then. What's something you think gets too much attention from your average retail investor?
Get rich quick. I think that's what it comes down to. It's seeing other people that making, whether it's crypto or AI, just making a killing in a 6-month period or something like that, and feeling like, oh, well, now I have to participate because the guy down the street, he's no smarter than me, and look how much money he made. And what you don't see the full picture. Most people don't talk about their losers. The water business or something that fell 80%, right? They didn't talk about that. They only talk about the ones that are up 6-10%. And so those cocktail stocks, or cocktail dinner sort of discussions, those are clouded and biased. So I do think you need to avoid some of these hot sectors, right? If you're thinking, well, I've got to participate in these things. You don't have to, right? You're not going to be penalized for not participating in something.
I'm going to start asking this question whenever somebody that comes back from Vegas that brags about the $2,000 they won at the blackjack tables. Well, how much did you lose at roulette? Right. That's, yeah, no, it's exactly to your point. Any last words of wisdom or otherwise before we wrap it up here, Todd?
I think it's keep learning. That's the key throughout my career, and be adaptable. I wrote a book in 2016 called Keeping Your Dividend Edge, and it was all about dividend investing. And I still stand behind every word I talked about there. But as I learned more, I found myself pivoting a little bit, right, towards what was probably even more accurate, which is finding great businesses with great stewardship, management teams, and not caring so much about how I'm receiving those returns, right? Whether it's cash or capital gains, and thinking about, okay, who's creating the most value? And so I still stand by everything I said in keeping your dividend edge, but I think it's important to be able to change around the edges if you find something that appeals to you more or feels closer to the truth, because that's what we're after. We're trying to be accurate and trying to get to what reality is.
Folks, Keeping Your Dividend Edge is still available on Amazon. You can buy the paperback. If you're a Kindle Unlimited subscriber, you can get the Kindle version for free. Check it out.
Don't tell them that. Make them buy the book.
Todd still gets money. He'll still get. Our boy still gets paid.
You should find the hardcover and buy that.
We'll drop the link for that in the show notes too, so it'll be there. Todd, thank you for that. That's great, because Jeff, this is your mantra. This is your new mantra: trade less, learn more.
Mm-hmm. Yeah,
perfect dovetail.
There you go. Love it. Todd, thanks again for coming on. We will definitely have to have you back on again sometime.
It's been great. Thank you very much.
All right, thanks, Todd.
Thank you.
All right, Jeff, any housekeeping?
All the normal stuff. Check out our Patreon. Check out our newsletter at investingunscripted.com. Subscribe to our Savvy Trader. Check us out on YouTube. All the normal things. If you want to know what we're doing, it's in the show notes. So in addition to checking out all of Todd's great stuff, join us on all our other endeavors as well, and we can keep this fun conversation going.
Okay, now we're done, right? This is it.
That's it. Wrap it up.
Okay. All right, people. Remember, we love to give our answers to these hard questions about investing. Have people that are smarter and better than us, like Todd, come on to give their answers as well. But remember, our answers are not necessarily your answers. It is up to you to do the research, own your results, and find your own answers to these questions. But you know what? I still believe in you guys. You can do it. All right, Jeff, we'll see you next time.
See you next time.